Good Monday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. This man, all the way from rainy Philadelphia, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent. Before we start looking at the pre-market, just a little heads up. Felix from Options Geek is on today. So I'm going to put the link to Felix's webinar in the chat.
All right. But he's on when? Tonight?
Tonight at 5. Yep.
Okay. So tonight at 5. You're going to do a webinar with Felix, and he's talking about like option order flow. That's what
I think it's the title is managing great risk reward trade ideas.
Okay. All right. So that will be interesting. All right. So today what we'll do is I'll start out with the pre-market report. If anybody has a question out there, please put that question on the live chat on YouTube. Will's watching it. He'll read it back to me. If somebody wants to come on a show and ask your question live, we also provide a link to Zoom. Click on that link, takes you over to Zoom. Once you're in Zoom, click on raise your hand. There's a button there, raise your hand. Click on that. You don't have to turn on your video camera. Once you come in, everybody will be able to hear you. You can navigate us to what you're looking at. So those are 2 ways to ask questions. While we're waiting for questions to come in, we'll review the pre-market report, see what's trading in the pre-market hours. Maybe I'll move on to another report looking at how the option straddles performed in the recent few weeks. So option straddles, you're buying a call, buying a put. It's non-directional. It's really based. It's a volatility strategy. If you're buying it, you want volatility to go up and to make big. You want the stocks to make big moves. If you're selling it, you don't want volatility to be high. You want it low. But we'll take a look at how these option straddles have been priced at the start of the week and how they perform by the end of the week. We'll take a look at that. Okay. Perfect. Pre-market report. These are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 56 stocks made our percentage gainers list, 88 on the decliners. So from this perspective right now, looks like we're set up for a slightly bearish bias at the open. I'm going to filter out this list to only S&P 500 stocks. We'll take out the small cap stocks, preferreds, leverage products, ETFs. Let's take all those out, see what's going on in S&P 500 stocks. To do that, I'm going to use this filter in here in ETF. I'm going to drop it down, and I have a bunch of ETFs that I could select from. The top one, SPY, that's the S&P 500 ETF. Let's select that. And the list below will get, let me refresh my screen. I think I've had this up since early morning. I'm going to refresh my screen. Let's select this one, SPY, which is the S&P 500 ETF. And we could see here 11 stocks made our percentage gainers list, 8 on the decliners. Slightly different picture there. This looks like we're setting up for a little bit of a bullish bias at the open. Couple things maybe to mention happening over the weekend. I see that a lot of these Chinese listed companies are getting sold off in the early morning in the pre-market. That's because of what's going on there in China with the politics, and they're solidifying. Looks like, kind of like the Communist Party is solidifying that power. So we're seeing a little bit of sell-offs there. that'll be interesting to watch because we did talk about those ADRs and how they're listed in the US, and people buying them don't have the same rights as you do in equities that you're buying on US listed stocks. And I think some people getting into them maybe don't even realize that part. And
we didn't. I think very few people realize the risk of what could happen to a publicly traded company until Russia, right? The whole ETF just went to zero. And and you look at the structure of these companies to begin with, there are a lot of flaws in them, right? Just from a real ownership standpoint, what do you actually own? This Cayman Island entity that has some sort of payout, it's very complex. And if there's an invasion in Taiwan, the repercussions are going to be huge, and it's going to affect these stocks and the value.
And what we've experienced with the Russian listed ADRs, the companies still exist. They still make, they're still in business. They produce their products. They employ people. Some of them are making profits. But if you had that paper and you own the paper to that ADR, it basically went to zero because your rights were taken away. It's not the same thing as the US equity listed, because who are you going to go sue? Are you going to go to Russia and try to sue for your share of the earnings? What do you do in that situation? And that perhaps is a risk there that's maybe starting to get discounted more, as well as the political winds change what's going on with China. See, Tesla's down a little bit as well. I think they lowered the price of some of the cars that they sell in China. So maybe, that, and they got a lot of stuff going on also with Twitter and all of that. If there are no questions,
Tesla also has risk. I mean, if the Chinese market ever closed up, and I don't know what delta we should put on that or what the chance of it happening, it's probably pretty small, but it would terribly affect Tesla, right? They've invested in operations. That's a lot of their growth is dependent on China going forward in their projections. I mean, it's a big problem. Plus, most of the rare earths come out of China. Chinese have control of most of the rare earths. So what happens to battery supplies? There's so many risks to Tesla if the relationship with China, derailed.
Right. And China now the second largest economy in the world, and China's economy touches the world. They have large tentacles. They're huge exporters. What are they, like the manufacturing powerhouse of the world, and their economy right now is starting to crack a little bit. We haven't yet experienced a Chinese downturn in the economy, right? So far, it's always been growing for 20 years, or since the economy's really opened up. It's been explosive growth. Now the growth has slowed down, but they are still growing. We haven't seen what a downturn and how that downturn will impact us and everybody around the world. But if that happens, I think that's going to weigh on all the economies, whether you're in Europe and America. We're going to feel it. I don't think we're insulated from that. And that their economy can be fragile. No economy can grow forever and never experience any kind of downturns. That's never happened, that an economy just boomed straight up and never had a downturn. And if they do, I think we're going to feel it here. And I think a lot of companies are going to feel it in their earnings here in America. To save time, if there are no questions, Will, I'll jump to that report.
Perfect.
Okay. Under here, options, this is the straddle and wing back test. And let me close this real quick. Before I do use the filters, let's just talk about what this report does. The report tracks options from start of week to end of week. And it looks at the money straddle. So on Monday, it takes a snapshot of the money straddle around 10 o'clock. It lets the options open up, waits till the options bid-ask spreads get a little bit tighter. So around 10 a.m., it takes a snapshot of the options markets. It looks at the money straddle. So the option expiration, that's the closest duration, shortest duration that has a week to go. So from Monday, it'll either expire Friday or it'll go past Friday, but it's the shortest duration expiration. And it'll look at what happened between that Monday and Friday to that straddle. It'll also do the same thing for an out of the money call and an out of the money put. All right. And the idea is, if we look at that strategy week to week, how does that perform? So let's do a simple example. I'm going to use the filters above here. It's set to look at the last 12 weeks. You could go back up to 26 weeks or shorter period, but let's keep it in the last 12 weeks. I'm going to set the strategy to just the money straddle. All right. I'm taking out the call wing, the put wing. Let's look at the money straddle. We want to see from the perspective of volatility, not direction. Did the stock move enough to cover the cost of the straddle from Monday to Friday, right? So you wait an entire week. Did that straddle gain or lose value by Friday, end of day Friday? And when we look at that straddle, the straddle can move around, and we think of options. You could hedge different risks of the options. One of the risks is direction, and direction risk would be on Monday. If the straddle moves up, then that means you have a long delta. That means that the call is worth more than the put, and now you have a bullish bias, or you want the stock to continue to increase, right? Because if the stock decreases, then all of a sudden that value you gained in the call comes back down, and the put, and you start decaying. And being long the straddle, as the stock goes up, you have gamma, you get longer delta, you have to sell stock against it to get back to delta neutral. If it goes back down, you have to buy it. But let's leave that alone for now. I'm going to take out the hedging, and let's assume we did nothing except buy the straddle, and then we held the straddle to Friday and did nothing in between. We didn't hedge, we didn't do anything to it. So over here, under the hedging, I'm going to say unhedged. Okay, we have these two filters. We're looking at the money straddle, buying a call, buying a put, to the strike closest to the spot price. And it's going to be unhedged. And then we're going to just wait to Friday. You could see here, the top one, Apple computer. Here's the money straddle. This is Apple's market cap. We could look at the liquidity of the options. Apple trades 1.3 million shares of contract, or 1.3 million option contracts per day on average. The spread between the bid and ask is 4 cents. Here we have it set to 12 weeks. Okay. And there's 12 observations in this output. And this is the output. For Apple, half the time the straddles were profitable, half were not. Out of the 12 observations in here, six of those 6 of those weeks it was profitable, 6 it was not profitable. What about the average return? And that's different than the times it was profitable, because it's not the payoffs are different, right? That doesn't mean half the time it was profitable, you made $1, and half the times it was unprofitable, you lost $1. The payouts are different. Sometimes it was profitable, could have made 300, 400, 500%. And the times it was unprofitable, could have only lost 10%, 15%. The idea is, well, what was the return on average, right? If I bought $1,000 of notional straddles every Monday, and by Friday, I got out, what was the average return on those straddles? And this says on average, they lost 1%. Apple seems like it was pretty, then over a longer period has been fairly priced. It's basically a break even there. The median return, so this is not looking at average, but the returns right in the middle. And the reason we're doing it is maybe there was one really big outlier that pulled the average up or down. What about the returns right in the middle? And you could see in the middle, it's they lost 18%. And if we wanted to look at those observations, you could click on this view here. It takes you down here, and you could see here week by week. Here's Apple. This is the strike price for the start of the week that we found. Here's the call price and put price. This is how much premium the stock would have to move by for you to break even above that to make. You could see how much it actually moved, and this is the return on the straddle. And this is what the stock did. So down here you have the 12 observations we're talking about. One of them was earnings, but you could go in there and take a look. Here, what is the standard deviation of the returns? And when we think about a strategy, we don't only think about, well, what did it return, but what is the risk? What is the variance of this strategy? In other words, if every week, the straddle returned exactly 1%, every week 1%, next week 1%, next week 1%, that means it has no standard deviation. It's just consistently returning exactly the same amount week after week after week. So there's no standard deviation. There's no variability. It's pretty consistent. But that's not realistic, not in risk assets. And you want to see, well, how much variance is there around this average return, right? How much variance from one week to the next in your returns? And you could see here, that's 91%. So it's a pretty big variance. Let's come back down here. Here are the returns. This is the unhedged. So you could see here, made 1.3% one week. The previous week, it lost 90% of its value. The week before that, it lost 79% of its value. The week before that, it's made 145%. A big variance from week to week. It's not negative 1% week after week after week. That's the average. The standard deviation, that measures the variance. How much can you expect from week to week? You could lose 90% of your money, 92%, 80%. There were weeks it went up 180%, 145%. The big variance, we're talking about options here, but that's the variance, 91%. Out of those 12 weeks, what is the worst that the straddle lost? Okay, so what's the maximum loss in those 12 weeks of observations? That was 92%. In other words, if you bought $1,000 worth of a straddle that week, it moved very little. You only got $80 back. right? 92% of the premium was lost that week. The best return out of those 12 weeks, 181%. All right. So that's giving you the not only the standard deviation, the variance of those returns, but now you have a low and high range in those 12 weeks. And then the Sharpe ratio, it's very simple ratio. It's trying to determine, well, how much return on average did I make for the variance, or the risk from week to week that I'm taking. And that's this over here. So you want a positive high ratio, because if you have a high return and zero variance, that's very good, right? Because then you could say, oh, I have a high return 10% week after week, and it's consistently the same. There's no variance. I could just rely on that. So that's the Sharpe and Rich. And remember, this isn't something going forward. This is looking backward. This is looking at how these options have been behaving in this particular stock, in this particular strategy, right? So that's what we're looking at. How in the most recent history, how have these securities been behaving? So we could analyze from different perspectives. We could look at, the most times that this strategy paid off, right, in the last 12 weeks. I'm going to filter by this. I'm going to sort it by this. And here, there's a stock, ACWX. It shows 100%. But right away, what do I notice is that in the last 12 weeks, we only caught one observation, which means that we couldn't, these options are too wide and too unreliable that our system skips it when it looks at it, that these options are just way too wide, way too liquid to catch an observation. We don't trust it, so it just skips it. Now, to counter that, let's do this. We could use our filters and say, in the last 12 weeks, we need at least 12 observations. So every week, we should have caught some, this doesn't mean that all these options are super liquid, but there is a threshold we put in there where it's a sanity check. Say, well, wait a minute, this is just, way too liquid for us to use that observation, because it's going to be just too funky. So to counter some of that, we'll say we had to have at least 12 observations. But you could see here that some of the spreads here are wide, and you can narrow this down as well by using this. And I mean, let me put it to 10 cents just to get a little bit more liquid options. And now at the top of the list, the ones that pop up, the first one is XLE, and this is an ETF. This is the energy ETF. And let me make sure, right? That's the energy ETF. Yep. Select Spiders Energy ETF. Here, this one happened, the Straddle happened to pay off, from the long side, 75% of the observations. Out of the last 12 weeks, 75% of them, the Straddle was profitable. Take a look here. We open it up. Here we see last week that we're looking at the October 21st expiration. So the options would have been expiring October 21st. So if you started October 17th, 10 a.m., this is where the stock price was. This is the call and the put price. The premium 4.3%. The stock by the October 21st at expiration moved up 6.5%. So you can see it went from 81.63 to 86.93, up 6.5%. The call was $5.43 at expiration. The put was worthless, right? So it went up. The put expired worthless. The call was $543. So if you paid $348.50 for one call, one put, that would $348.50. The call at expiration, it was worth $542.50. So you could see the return was $194, which was a 55% return. Okay, on what you had at risk on the unhedged, on the unhedged strat. I mean, you never hedged, you never did anything, held it from Monday to Friday. Okay. So let's take a look at the rest of the stats here. 75% of the last 12 weeks, it was profitable. On average, it returned 34%. So you could see here it is, you know, some pretty high returns. I mean, this one's down 65%, but we had 93%, 100%, 91%. A couple big hits here, 95% here, 86%. You could see, you could take some big hits as well, right? But on average, it did return 34%. The median return, 54%. You could see the variance around the returns, 65%. So less than the Apple one that we saw, right? The variance around Apple was greater. The worst was 80%, right? The worst was, oh, hold on a second. This is, am I doing the unhedged? Take a look at that. And the best was 128% with a Sharpe ratio of 52. Although I gotta check this one. Am I looking at the right one? All right, I gotta check this one because I do see a worse one than 80% right here. So I want to see if that's a bug. But that's the summary stats for that straddle in XLE. Will, if there are no questions, I'm right up at 9:30. So
yeah, that was great. We just had one question and I answered it. This is not a new feature, right?
No,
This has been around for quite a while.
Yeah, this has been around for a while. So this is not a new feature.
But it is very interesting to bring out. I mean, we're 20% into the earnings season right now, so it's interesting to look how they've been performing. That's for sure. Thanks, brother.
Yeah, definitely. All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Great job, G. Trade and Peace Chameleons. Remember, webinar with Felix Frey tonight. I did attach the link in the chat. Hopefully, we'll see everyone there. Have a great day, D.